Once a venture capital fund makes its initial investments, the real work begins. Managing a portfolio is not a passive exercise. It requires active decision-making across multiple dimensions, deciding which companies to double down on, when to provide bridge financing, how to navigate follow-on rounds, when to push for an exit, and when to cut losses through write-offs. A well-managed portfolio ensures that capital is strategically allocated to maximize returns, that winners are fully backed, and that underperforming investments don't drain resources or distract from higher potential opportunities. The best-performing VC firms do not just pick the right startups, they actively manage their portfolios to optimize growth, liquidity, and long-term value creation. Follow-on investments are crucial in venture capital, allowing funds to maximize returns by doubling down on their strongest performing companies. Not every startup in a portfolio will succeed, so investors must be selective in where they allocate additional capital. The best funds take a disciplined approach, typically reserving 50 to 60% of their capital for follow-on rounds, ensuring they can continue backing companies that demonstrate real potential. Deciding whether to reinvest requires careful evaluation. Investors look at whether a startup has achieved key milestones, such as product market fit, revenue growth, and customer retention. Market validation plays a role as well. If external investors are eager to lead the next round, it signals strong demand. Ownership strategy is another factor. Additional investment should allow the fund to maintain a meaningful stake in the company. At the same time, risk-reward balance must be considered. The right follow-on investment supports a company's momentum rather than just prolonging its runway without clear traction. A strong follow-on strategy is not about spreading capital evenly across all portfolio companies, but rather concentrating resources on the few that will drive the fund's returns. The goal is not just to have a stake in the next unicorn, but to ensure that when a company reaches a liquidity event, the fund holds a significant share, maximizing potential upside. Bridge financing is a critical yet complex tool in venture capital, often used to help startups survive between funding rounds. Startups sometimes require short-term capital to hit key milestones before securing a larger round. However, not all bridge rounds serve the same purpose. Some provide the necessary runway for growth, while others simply prolong an inevitable failure. Investors carefully evaluate whether a bridge round is truly justified. A compelling reason for the funding might include closing a major enterprise deal, finalizing product development, or reaching profitability. They also consider whether the bridge leads to a viable next round, such as a Series A or B, or if it is merely delaying an unsustainable business model. Another key factor is investor alignment. If multiple investors hesitate to participate, it could signal a lack of confidence in the company's future. Typically structured as short-term convertible notes or safe agreements, bridge rounds should not be driven by emotion. If a startup has consistently failed to gain traction despite previous funding, injecting more capital may only delay its inevitable collapse. Many VC firms establish strict internal guidelines to ensure that bridge financing is reserved for startups with a strong probability of securing additional funding, preventing resources from being wasted on companies with little chance of long-term success. As companies progress through funding rounds, investors face a crucial decision, whether to lead, follow, or step back. Leading a round requires strong conviction in the startup's potential, sufficient capital, and the ability to set favorable terms. Some firms take this path to increase ownership and control the deal structure. Others prefer a supporting role, investing alongside a new lead investor while maintaining a meaningful stake without taking on the full responsibility of setting terms. In some cases, when valuations rise too high or new investors bring greater value, VCs may choose to step back, allowing their ownership to dilute rather than overcommit capital. Managing funding rounds effectively requires strategic capital deployment, ensuring that funds maintain strong positions in their winners while avoiding excessive investment in underperforming startups. Experienced investors also align with external firms to create an optimal funding path, balancing ownership retention with partnership opportunities. Beyond valuation, each round involves negotiations over governance aspects like board seats, voting rights, and liquidation preferences. The most successful funds navigate these complexities to ensure that their portfolio companies receive the right capital under terms that support long-term success, avoiding unnecessary dilution or misaligned incentives. Managing exits is the defining moment for any venture capital fund, where paper gains are converted into real returns. Exits typically happen through IPOs, acquisitions, or secondary sales, each with different implications for investors. An IPO is the most coveted outcome, offering the highest valuation multiples, but it comes with holding period restrictions that delay full liquidity. More commonly, startups exit through acquisitions, where strategic buyers integrate them into larger operations, sometimes at early stages. Secondary sales provide earlier liquidity, allowing funds to sell stakes before an IPO or acquisition, a growing trend in venture markets. In less ideal cases, startups may be acquired primarily for their talent or intellectual property, returning partial capital to investors. The timing of an exit is critical. VCs must assess whether to push for liquidity or hold longer to maximize returns. Market conditions play a major role. Strong IPO markets create more opportunities, while downturns make public listings difficult. Competitive dynamics can also force a decision. If consolidation is happening in a sector, selling to an acquirer may be preferable. Meanwhile, LPs expect distributions, and fund managers must balance the need for near-term liquidity with the potential upside of waiting for a better exit opportunity. Ultimately, the best VCs work closely with founders to craft an optimal exit strategy, ensuring both investors and entrepreneurs achieve the best possible outcome. Not every venture-backed company will succeed, and in fact, most will fail. Knowing when to cut losses is essential to effective portfolio management. The clearest signs that a startup should be written off include repeated failures to achieve product-market fit, persistent struggles to secure follow-on funding, poor financial discipline, or significant internal dysfunction such as founder disputes or legal issues. Writing off investments is never easy, but the best funds approach it with discipline, ensuring that capital isn't wasted on companies unlikely to generate meaningful returns. A structured process for reviewing underperforming startups, either annually or on a case-by-case basis, helps firms redirect resources toward higher potential opportunities. Ultimately, recognizing when to move on is a mark of strong portfolio management, allowing funds to maximize overall returns rather than holding onto struggling bets out of emotional attachment or misplaced optimism. Great venture funds aren't defined by making one great investment, but by how they manage their entire portfolio. Long-term success comes from aggressively backing winners through follow-on investments, ensuring struggling companies have a real chance with selective bridge financing and strategically managing exits to maximize liquidity. Cutting losses early and reallocating capital where it has the highest return potential is just as critical. Venture capital operates under a power law dynamic where a handful of companies drive nearly all returns. The funds that consistently deliver top quartile results are those that master the art of follow-ons, funding rounds, exits, and write-offs. Managing a portfolio effectively, not just picking winners, is what separates the best VCs from the rest. Managing a VC portfolio requires a disciplined approach to follow-on investing, bridge financing, exit strategies, and write-offs. Successful funds aggressively back winners, strategically navigate funding rounds, and optimize exit timing for maximum returns. Cutting underperforming investments early prevents wasted resources, while careful allocation of capital ensures sustained portfolio strength. In venture capital, success isn't just about making great investments, it's about managing them effectively to maximize long-term value creation.